Welcome to SmithWeekly discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position along with your favorite beverage to enjoy the discussion. Before we get to our guest, we want to thank our audience for questions coming from @FeedsExplorers, @IamImprem, Julian S., Anhill O., BCS, Hayden L., Jonathan J., Marcus K., Nick D., @Cloud Magellan, and Terry P. So today we have Master Uranium Expert, Mr. Michael Alkin on the line. Mike is Chief Investment Officer and founder of Sachem Cove Partners, LLC, a uranium vehicle that has been set up to reap the coming rewards in the uranium sector. Michael, welcome.
Andrew, how are you? Thanks for having me. By the way, nobody's ever called, my kids and wife would laugh if they heard you call me a master at anything, so.
Yeah. Like falling off ladders, right?
Yeah, exactly. Yep.
Oh, good. Well, I thought we'd get some kick out of that.
Yeah.
Mike, another funny question on the comedy side. Your Twitter profile picture with the guy with the stogie in his mouth.
Yep.
Is that you back in the day?
That is my favorite TV show of all time, Columbo. Detective Columbo, Peter Falk. And, Columbo was always the guy that was kind of a little rumpled and the guy that people just kind of underestimated, and he just kind of was just doing his work but always had his eye on the ball. So that it was always my favorite TV character.
Oh, good. No, that's good stuff. And I didn't know that. I'll have to look up that show. And of course, that kind of puts my age in light. And
yeah, exactly. Yep.
So tell us about Sachem Cove, the funds under management. Tell us about the team there and the reason why folks should look at this business.
Well, it's. I just want to be clear. This, it is a private investment partnership. The firm is an investment firm formed to invest in the uranium cycle. We express the view through a vehicle that is a private investment partnership only available to accredited investors. I won't go into a description of what that is. People have to look at what an accredited investor is. In terms of what we do, we scour the earth looking for both public and private uranium investments that to express our bullish view on the uranium sector. So that's what Sachem Cove is.
How's the work going there?
No, it's going well. I mean, look, we have this has been the last 3-ish years of my life has been devoted to really understanding a very opaque, complicated industry. From my perspective, having been in the hedge fund business over 20 years and being a generalist for the most part, especially the first portion of my career, and I was a short seller, pretty much a dedicated short seller early in my career. But what you learn is when you're a generalist, you look at all sorts of different industries, and you parachute in and you try and understand the fundamentals of the industry, and by doing your own analysis, the financial analysis is one thing, right? So balance sheet, cash flow statement analysis, income statement analysis, and understanding capital structures. That's part of being a financial analyst. But the hedge funds that I worked, our job was really to be like detectives, investigative journalists, detectives with a lot of financial chops that knew how to do a lot of deep dive financial work. But our goal, my career was spent analyzing industries across the globe. Pretty much every industry out there I've probably looked at in my career. Sometimes you're in there for a cup of coffee, a brief view, and you might spend a few weeks or a month. Or other industries, you might really start to form a thesis and spend many months or years sometimes doing it, and you might not look at that industry again for a couple of years, but you come back and take a fresh look at it. And it just depends what what you're looking for, whether on the short side or the long side. Sometimes you get an industry that you sink your teeth into, and you're out in the field. The newsletter industry likes to call it boots on the ground research. Whatever. It's primary research. It's field research. It's forming an opinion based upon compiling a consensus, a mosaic of information. Because there's consensus, which is the sell side analysts, which have, if they're covering the industry, which most industries have it, and we'll get to uranium and how that's pretty much disappeared. But there's some consensus of numbers for expectations, and that's formed typically by the sell side. And your job as an analyst in the hedge fund world, or as I won't speak to what mutual funds and other private money managers do, but your job is to go out and understand if consensus is correct. And the way you do that is by talking to people throughout the supply chains, throughout the cycles, throughout the supply chain of the industry. So you might talk to suppliers, you might talk to customers, you might talk to people who are providing services to the industry, consulting services to the industry. You speak to former employees in the industry or industry people who consult on the industry. You're just looking for information, and you're looking to take all those pieces of information and going out into the field and talking and interviewing them and putting that information together to see if it squares with what consensus is. And you're taking the numbers, right? So if you're looking at any industry, whatever it may be, if you're looking at, well, what's the revenue? How do you generate revenue? What's it comprised of? Is it comprised of price and comprised of volume? And when you're looking at your profits, what's the mix of what they're selling? Is what percentage of lower price products, mid price products, high price products, and is that changing? Is that morphing over time? And if so, is that being captured in the consensus numbers? Are people coming at? Is there new technology that's causing changes to an industry that's causing the cost curve to go down? Is it being captured in consensus? Is there something new that's going on? So that's kind of how you go about looking at it. And so, 3 years ago, what caught my attention was the uranium industry. And through my career, I've worked at a couple of hedge funds that had a deeply cyclical, very value-oriented bent to them. And so industries that are either very in favor, out of favor, that are deeply cyclical, are something that I tend to be drawn to. You tend to have to bring a contrarian's eye to it, or an approach to it, which is not always easy. But that's because you're oftentimes looking to see consensus is typically very strong in one way. If a market is in an elongated bear market or in an exceptionally elongated bull market, if an industry is in one of those markets, consensus tends to capture all of the good stuff and all of the bad stuff if it's in the bear market. And over time, even the industry participants, they envelop the consensus. If you're in an industry that has been beaten up for 4 or 5 years, and you're working in that industry, and you've seen colleagues and people just losing jobs, and you start to hear people are human, and you start to see people disappearing, desks emptying out, guys you used to confer with on a regular basis are no longer there. This guy lost his job. That guy lost their job. You start to take over that. It starts to permeate everywhere, and the negativity starts to occur. Now, in most industries, there's a lot of eyeballs looking at it. So, in these deeply cyclical, industrial cyclicals, or machinery companies, or natural resource companies, big copper, there's tens of thousands of people analyzing and looking at these. There's countless number of sell-side firms that are writing research on them, because most of them have big companies. and there's a lot of banking business to be done, and so there's still attention paid to it. They're big markets. Uranium is different. Uranium at one point was 130 plus billion industry going back, into the middle part of the 2000s. When I started looking at it, it was a little over $4 billion industry, and half of that was in one publicly traded company, Cameco. And so what happened there was the institutional investor disappeared. If you're running any fund of any real size, you can't invest in an industry that small. If there's one company that you could choose, if you're running a $1 billion fund plus, or you really don't have. If you wanted to have a 3 or 4% position in a company, you need to buy if you're just $1 billion fund, you need to buy $30 million worth of stock. Well, in many cases in the uranium industry, that could have been many of the companies. So, and you typically, as a fund manager, most guys don't want to own more than 5% of a company, sometimes more 10% of a company. You get into control issues. So it really limits. So you started to see the institutional interest dry up. Funds are not in the business of catching falling knives, right? It's a very competitive landscape. If you're running a hedge fund, or if you're running a mutual fund, you're competing against your peers. And so, when industries aren't working, time isn't your friend necessarily. You don't have the luxury of saying, "Here's an industry I think is mispriced. I'm going to wait it out for a year and a half or 2 years because I've never seen values like this." But it could take a while for the healing to occur. They don't have the luxury of time because they're reporting numbers. If you're a mutual fund, it's daily. If you're a hedge fund, it's monthly or quarterly. And so people tend to avoid the really beaten up industries if you're a generalist hedge fund. And so the uranium industry had just a complete vacancy from, and still mostly does, from institutional investors. And that caught my eye because I couldn't really recall an industry when I started really diving into it 3 years ago that was so vacated, that was so left for dead, and yet was so important to the global landscape, the global energy landscape. And specifically in the U.S., nuclear power is 20% of the electric grid. It's 12% of the global electric grid, and it's big business. It's meaningful. I mean, it changes countries and lives. It's important, and but yet the institutional ownership was gone. The number of companies had shrunk from 500 at the peak to 50 maybe, so as an analyst, you go back to the Colombo stuff, right? On my Twitter picture, you're out doing investigative work, and so one of the things you start when you're an analyst working at one of these funds is bring your professional analytical eye to it is let me see what the sell side is saying. How are they thinking about it? And by sell side, I mean the investment banks and the research that they write. And as I started to look at some of the research that was out there, what caught my eye was many of the major investment banks had closed down their uranium research business because there was not anything to be done. You weren't going to employ a bunch of research analysts at a major investment bank to write about uranium companies that none of your institutional clients cared about. And there was very little investment banking business to be done, well, maybe with the exception of Cameco, but for the smaller companies, they were in survival mode. And they were too small. They had market caps 30 million, 40 million, 50 million. That's your average institutional client isn't going to be interested in those type of companies. So now there was some in Canada. There were still some investment banks that were smaller, a couple of small U.S. banks that were covering it, but not a lot of eyeballs on it. And what happened in the uranium world is is these analysts had been calling, not all of them, but many of them had been calling for a turn in the market for years. So that never occurred. So their voice was falling on deaf ears. And so for me, as I started looking at it, I said, wow, this is a pretty cool setup. You've got an industry that's been left for dead. It's a meaningful part of the global electric landscape. The institutions aren't there. Let me explore it further. And that was, I laughed when you
Right.
introduced me as master expert uranium guy. 4 years ago, I couldn't have told you anything about it. I had looked at it a couple times in my career for very brief moments, and just moved on to something else. And my wife and kids would laugh you calling me a master and expert at anything. So, but I realized then, go to where others aren't. I like throughout my career, I tended to find my best ideas when you're fishing alone, when you are looking where others are not focused, because that's where you can find asymmetry, right? Much more reward than the risk you're taking. So
Right.
that's how my journey began in uranium.
Yeah.
3 years.
Yeah, and for the record, we don't think you're a master expert at uranium, but we can say with that that of any of the people out there that proclaim to be an expert at these types of industries, we can say that the amount of hours, whether it's 5,000 plus or whatever it's been that's added up over the couple of years, we can say that you've done a lot of work on the business, and
Look,
so
I
you're
could
certainly
say
getting near that.
Well, what I can say is, I speak to groups. I spoke recently to the Nuclear Energy Institute, and I'm happy to tell when I'm talking to a room full of people that are in the nuclear fuel industry, I am not a nuclear engineer. I am not a mining engineer. I'm not a geologist. But I understand the laws of supply and demand. And more than anything, I'm a grinder. I know how to put numbers together.
Right.
I know how to fire up a spreadsheet, and I know how to go find information. And that has been a big part of what's created my conviction in the industry. Now, what I will say is, I have, because I'm in the field talking to people doing this, and I'm not afraid to say, explain to me what that means. And I'm not the sharpest tool in the shed, but I'm a pretty quick study on stuff. And what I don't know, so I made it my life's mission to really understand the nuclear fuel cycle, understand how it comes out of the ground. What's the next step? It goes to conversion. From there, it goes to the enrichment. From there, it goes to fabrication. And every step along the way, I made it a point to really understand the drivers of each of those, and to understand what caused pricing to move, what drove excess supply, what caused demand, what drives the demand in there, who are the players. So what is so I made it a point on every step along the way to just do a really deep dive, and I would go out into the field and talk to people. I'd cold call people. Here's who I am. Here's what I'm doing. I'm trying to get smart on this. I'm probably going to ask some stupid questions. Would you mind give me a little bit of time? People are very, very helpful out there. And then, like anything, I read. I'm a voracious reader. So if I wanted to understand, again, I learned a long time ago to know what my strengths and weaknesses are. I'm not a mining engineer. I'm going to go find them. I'm not a geologist. I'm going to go find them. And I'm going to ask them to help to educate me. And what are the things I need to pay attention to and not? And also know that I'm never going to have that level of expertise, but I'm going to be able to kind of know what they should know and judge what they're telling me. And of course, you want to know what's their history, what's their background, where have they been successful, where have they failed, right? I was a quarterback in high school. And my job was to know what every player on the field, what their role was on every play. I had to know that, right? So it's no different. It was the same. And so So for me, as I started that journey, it started to come together, right? But what drove me before I did all that is I wanted to see if it was worth my time, worth my investigative time, and that's when I started getting numbers. What is consensus? Who forms consensus? The sell side isn't really there. As I started looking at some of the sell side numbers, I started noticing there were references to the World Nuclear Association, references to other consulting firms. And I said, oh, okay, well, one of the big things that drives me is understanding people's financial incentives. It's so important in everything I look at. And, so tell me about this organization. Who are their main subscribers? Who belongs to it? Who pays their fees? How does that work? Oh, okay, so the utilities are the big drivers of these. Okay, well, I don't know what that means, but I understand it's not the uranium miners that are keeping these organizations in business. It's the consumers of uranium. Okay, well, maybe, just maybe, there's something behind, something to investigate in that. That meaning investigate, understand how are the numbers put together, what's factored into it. And so as I started looking at the numbers and I started going to conferences, I show up at a nuclear fuel conference, at a fuel buyers conference, at a nuclear association meeting, and
Right.
It's not cheap. You pay your $2,500 and you show up and you spend 3 days and you listen to meetings and you go grab a cup of coffee and you shake somebody's hand and say, here's who I am. I'm going to ask some stupid questions. You got a minute? And embarrass yourself, right? And just go out and do it. And
Yes.
so when I started doing that, I started to look at the numbers and I said, well, that's interesting. The association really doesn't get involved in forecasting the price of uranium, so their forecasts that are out there for existing projects, those existing projects continue out into the future until the life of that mine expires. Nowhere in there, though, am I noticing what the cost of these projects are. And then on some future stuff that's coming down the pike, there's some layered in there that's going to be future projects will come in, and some of those are coming in, and it really doesn't kind of matter what the price is. Well, how is that possible? And that's when I started to say, well, wait a second. It might be here that in this that the way these numbers are compiled, if forecasting of price isn't factored in, well, geez, I know at the time that the price of uranium was in the low 20s, and I knew from doing some reading that the average cost to pull it out of the ground was somewhere $40 to $50. And I said, well, I'm not the sharpest tool in the shed, but if something's costing you more to sell than it is to make than it is to sell, that math doesn't work, right? So something's got to give. And as I started to then look at some of the numbers put together by the sell side, they were referencing these organizations, and I said, well, wait a second. You've got an industry that is left for dead. Say what you want about professional investors, the institutions. One thing I can tell you is you got a bunch of really, really, really smart people in those places. And when they fire up their spreadsheets and do math, they get the math right. They may not get the judgment right, but they could do supply, demand, and all that stuff. But nobody's really paying attention. There's no ownership in these things. And if I'm a sell side analyst at a firm, and I'm a mining analyst, and I'm not a uranium mining analyst because that guy's been fired, and I'm a generalist mining analyst covering the big mining companies, I'm not going to dive down into the nuances of nuclear power. It's complicated. I'm going to use what the industry says. And that's when I started to say, wait a second, there's something here. And then I started looking at some of the other bodies that put numbers out there. I was comfortable that those numbers weren't reflective of what I thought might be occurring. And that's when I just said, let me go out and understand the case for nuclear power. And because, as a Westerner, I didn't know that nuclear power was 20% of the U.S. electric grid. I didn't know. I thought nuclear power like anyone else. I thought, geez, nuclear power, it's kind of probably dying, isn't it? What do I know? But I said, let me see. I knew throughout my career I've looked at solar and wind and alternative energies, typically from the short side. So I said, but I know they're growing rapidly, so let me see, is there a case still for nuclear power? And right, and let me see where do they is it a competitive thing? Is it a complementary thing? And I investigated that, and I concluded that for electric utility grid scale, wind and solar weren't ready for that yet, but they were growing by leaps and bounds, and they have their place. But storage costs were really high, and I walked away after a few months and said, I think this is complementary, and then I started really diving into the fundamentals of nuclear power and what's the case for it. And after a few months of that, I just said, wow, I'm sold, hook, line, and sinker. Clean, carbon-free, the safety element of it on a per terawatt hour of anything produced is the safest out there. It's 2/3 of the U.S.'s carbon-free emissions, and I thought, wow, that there is a case here for it. Now, so what was going on? Well, low natural gas prices was what was going on, and I always knew nuclear power plants just from reading the papers were really expensive and always over budget, but most of the costs are capital costs. They're big sunk capital costs. A big reactor costs you $10 billion, $12 billion, pick a number. If it's supposed to be online in 5 years, figure 12, at least in the West. And the maintenance costs are high, big regulatory burdens. I kind of probably knew that in the back of my head just from osmosis of being an investor and reading a lot. But as I started diving into it, something jumped out at me, which I wasn't aware of, was the feedstock element. Was the nuclear power, uranium itself. The front end of the fuel cycle could be 17 to 18 to 20% of the overall cost of a reactor, but the actual uranium itself can range, depending on price, from 4% to pick a number, 7-8% in that ballpark, versus coal and natural gas, which I knew better because a couple of the firms I was at had big energy presence. And sitting in meetings and listening to my partners talk, I knew that coal and natural gas could be 70 to 80% of the operating costs. So as I looked at this clean source of power that was carbon free, and I realized that the price of what the utilities pay, it's not insignificant, but it's much lower than alternatives. But with the shale revolution in the U.S., natural gas prices imploded. So the utilities were shifting to natural gas-fired power plants, and coal was going away as the dodo bird. And but as I started looking at it, I said, okay, well, let me lay out all the reactors in the world, and I fired up Excel, and you got to go find this information. Let me look at all the reactors.
Right.
See how big they are. When did they come into existence? When does the license expire? What are the chances that the license is going to expire? And then let me take every reactor that's out there, and let's look at it by country, and let's take a look and see what countries are going to be taking the nuclear power and making it less of their energy mix, or maybe closing it down. Obviously, Germany is one. Switzerland's heading that way. The U.S. is under great pressure with low natural gas prices. So I then started to compile by country the likelihood of what reactors are going to start coming off the grid. And I wanted to then understand that by country. Of all the nuclear producing countries, and take a somewhat draconian view of that, and take those reactors that I thought were not competitive out. And it required a lot of research and investigation. And then I did that, and then I said, okay, well, let me take a look at the reactors that are under construction. And what stood out at me was that this time period, if I went back to the time the last cycle turned in 04, 05, and started to go from its long death knell to a turn, there were 23 reactors under construction at the time, and there was big mines coming on, millions of pounds, tens of millions of pounds of new supply scheduled to come online. And I looked at this environment and I said, well, wow, at the time there were 60 reactors under construction. And that's where I started to do the math. I said, well, wait a second. Because I had started to lay out all the mines in the world by country and all the new projects that would be needed. So as I laid out the reactors by country, all the heavy closures, and all the new reactors that were going to come in by country, by year, through 2025, 2026, as I started looking at that, when I did that math, I said, well, wait a second, nuclear power is actually a growth industry. And again, I was draconian in my closure assumptions. U.S., France, I was very aggressive. Belgium, Germany, Switzerland, South Korea, for where and then I started to layer in those under construction. And then for my forecast period, which goes out to 2030, I'm sorry, on a few different things, it's 2028, 2029, 2030. I started looking at all of the countries around the world. Well, where is it growing? It's growing in the emerging markets, right? You could bring millions of people onto the grid, and you could bring them on, and you've got clean, pollution in China and India is horrific. It's at crisis levels, but here you could bring on clean energy, and in countries typically where the population doesn't have much of a say. Right, you're not going to see a lot of anti-nuclear protests in China. So you started to as I started to do that, I realized in my draconian growth assumptions, this is kind of a 1% grower, give or take a little bit. And if I started to layer in some of those planned and or proposed reactors, I didn't layer in any proposed, but going way out into my forecast period, let me bring in just a small fraction of some of the planned reactors. They have approvals, they just haven't been constructed yet. You can dream up a little dream and see it's a 3% grower, right? So I looked at that and I said, there's something to do here. And that's when I then was layering in, when a new reactor comes online, it consumes in its initial fuel load at least 2 times the amount of uranium it will consume per year. Some people use up to 3 times in their math, but I used 2. And as I started doing that, and then I started looking at when some of these mines were scheduled to come offline, some of the bigger mines, and then I started looking at when the cost to operate these mines, and I'll get into that in a second. But as I started doing that, that I'm dealing on the primary mine supply side. Now, where the association doesn't take into account forecasting price, I certainly can. And I started to say, well, wait a second. The nature of the industry is such where, even though the spot price of uranium had gone from 137 back in 2007 down to low 20s, that's not the price these companies were selling off of. The nature of the industry is such that they have long-term contracts. So the price of uranium could have been at 23, but companies were selling at $50 and $60 and $70 contracts. And they don't have total exposure to spot, so they could have been covered. And so as I started thinking, I said, well, when those contracts start to expire, my gosh, how can you re-enter new contracts if the spot was 23 and term was 30, longer term? What CEO could actually do that and keep his job? How do you do that when it costs you $40 or $50 to pull it out of the ground? You can't. So that's when I started to take some liberties in my analysis. Said, okay, well, let me get my head around going reading all these reports, listening, talking to companies, reading what they're saying, and who are the ones that are really going to be at risk, and how many pounds are going to have to come out of supply. And at the time, that wasn't part of the math. That wasn't part of consensus. Consensus was, hey, all these things are there and there's all this secondary supply. And when I started doing just basic supply, demand, and economics, knowing how a public company works, and that's most of these, with the exception of Kazakhstan, which now is, but at the time wasn't, it was pretty obvious to me that a significant amount of supply was going to have to come offline over the next 12 to 18 months. It just had to. You can't, Rick Rule has said this, and it's right. You can't produce at 50 and sell at 20. The math doesn't work, and it's just obvious. But that, again, no eyeballs looking at it, institutional wise. Sector left for dead, and there you were. So that's what started to get me really excited. And then I started to get into secondary sources. But I've been rambling, so I'll let you ask me questions.
Well, Mike, that's been a long-winded, comprehensive view, and I would suggest that the audience take some notes and prepare for a longer session here. So I think what you said, there's a lot of interesting points, and people should become familiar with Excel. It's a very powerful program, and you're going to need it, especially if you want to really understand all the way to the bottom. So you have to have that organizational tool.
I'll tell you the beauty of this, Andrew, is my kids laugh because I can't help my 15-year-old daughter with geometry, or calculus I probably snuck at. But I was really good at fourth grade math, and really
perfect.
That's all you need to understand finance and supply and demand. If you could add, subtract, multiply, and divide, you got it. But in the world of uranium, you got to roll up your sleeves, and you got to go out, and it's a grind, and you got to just be prepared to spend a ton of time. And if you're prepared to do that, and you know how to do basic math, then you could start to get there.
Right, absolutely. So Mike, moving on. So we know you represent Sachem Cove and yourself personally. While you might not be able to comment on Sachem, you personally you've been mute regarding your real thoughts on some of the best companies you like in the uranium space. So are you breaking that silence with us today? And if not, why?
I am not. A couple of things. I'm quite cognizant that over the last year and a half or so that I've become a public voice of uranium, which is just random. I mean, who knew? I gave a presentation in April of 17 on Real Vision, and then it turned into speaking at conferences and then having industry associations asking me to speak because I brought up some issues that hadn't been discussed and hadn't been explained, and that turned into a public thing, and one thing led to another. And like I said, I laugh when people call me a uranium expert. But there's a vehicle that I'm in charge of, and the first thing is I don't want to use my voice, my public voice, as saying, here's something I really like, because I don't know who's listening to me. I don't know if it's something that they want to own or not. They don't know why I want to own it. I have a vehicle that has a time horizon, an extended time horizon, and there are investors in that vehicle who have an extended time horizon. Now, I think that time horizon is very soon, but I don't know. Some people might be traders. Some people might like to whip stuff around. I pay no attention to that stuff. I don't want to be influencing them, and I also have an obligation to my limited partners, who are paying me to do that, to provide my best efforts for getting at the best prices that I can, investments in this vehicle. So I don't want to unnaturally influence the price of a stock because I come out and say, oh, here, I really like it, and here's what it is. These stocks are so thinly traded. This isn't Apple. This isn't Microsoft. This isn't where if I came out and said something, who cares, right? Nobody cares. But these stocks could trade $20, $30, $40, $50,000 a day. There's nothing. There's no volume. So I could be out in the market at any given day accumulating shares. I could be buying a block from somewhere. There are times where I might be financing through a private placement something, and there's all different reasons. I'm happy to share my macro view, and people shouldn't take my word for it. Do their own investigation. One of the things throughout my career, I've been wrong plenty. If you're a good investor, you're going to be wrong. And throughout my career, I've had investments that have not worked where I thought they would work with best efforts and everything. So, but I'm happy to share my work on it, and I'm happy to share my thought process on it. But in terms of the companies, for myriad reasons, I don't like to talk about. And also, quite frankly, Andrew, I'm on Twitter, and it's a big platform. And if I start talking about individual companies, I get bombarded with direct messages. I get bombarded with people tweeting me, and I've done and. Again, I think my work is right, but it may not be. But I've done an enormous amount of work, whether it's on the industry and on the individual companies. And so if I'm to start opining on something, and I've seen it on just different things, on the macro uranium stuff, people come at me with a million things, and I would spend all day on Twitter. B, almost all of it that comes at me is random, and it's well thought into my analysis. And I don't have the time or the interest in debating and arguing people for stuff that's half-cocked, right? So anyway, and right. So there is a proprietariness to my work, and the proprietariness is reserved for the vehicle that I have.
No, very well, and I think it's important that the audience and folks need to understand your position on it, because their position is different than your position. And, again, we don't have the time to discuss, there's plenty of stuff out there. Do some research. There's lots of free stuff out there on the internet. You can start with that, and, bring the intelligent debate from there. But,
I love intelligent debate. I love intelligent, and I love people coming at me with a great bear case. And as you could probably imagine, I'm sure you see it too, being public on uranium. I get it every which way till Sunday. But after a couple of years now, and I encourage it, it does get a bit exhausting answering the same questions over and over that are just not accurate. They're unfounded. They're based on not a lot of analysis. So after a while, I've really toned down my commentary on Twitter. If I see something that somebody says something materially incorrect, then I'll chime in. But a lot of time people I'm dealing with institutional people who are trying to get up to speed on the industry, and there are some bearish people come at me with that, and even there, a lot of it is very obvious. Right, the obvious bear case. That's kind of what, when I came at this industry, by the way, and I didn't mention this, when I started doing my work, like I said, my first 10 years of my career, I was a dedicated short seller. I mean, I was in the weeds. I was looking for bad companies and bad guys and looking for bad stuff. I came at this and said, let me see if I could prove the bear case, and if I can, I'll go look at something else. And I couldn't, because the bear case was so obvious. And the bear case that I see is that, look, there is a bear case, right? Of course, can a reactor blow up? Yes. Can China stop buying uranium? I suppose they can. Can they never build another reactor like some people say? Well, yeah, I'm sure. Okay, and is all this uranium going to come out of the ground when the price gets to $40? That's what consensus is. Yet no. And I could explain my thoughts on that. But so yeah, there are some good ones, but I think people, there's enough information out there on the macro uranium thesis for people to dive in and do their own work.
Right. Absolutely. And you know, we respect your decision on this, of course, and we needed to ask it, and we may twist your arm a couple more times before this is
Yeah.
over. But we wanted to ask it for the sake of our readers
I,
who ask us
I
to
could.
ask you.
No, I
And
totally get it. I totally get it. And look,
right, right.
I own a few of the companies that you would expect I would own.
Sure.
Right,
And
and some of the great assets, right?
right. And look, if people want to know what Mike Alkin's doing, go ahead and join the fund. Go ahead and put your money where your mouth is and join his fund.
Well, even they don't know.
Right.
They,
So,
we tell our investors, you know, they get commentary from me. They can speak to me, but they might know a couple of positions we own.
sure.
But that people who invest in hedge funds understand how that works.
Right.
But yeah, so and it is sure. But
there's no doubt that being a part of the fund, you do get direct access to Mike. You do get more information that obviously Mike would share with certain clients, so it makes sense.
Yep. Which we're very close to not accepting new ones because we're happy with where our asset level is. But but yeah, okay, I'll give you one. Do I like Next Gen? Yes. I do I think it's a world-class asset that is materially mispriced? Yes, I do. So there you go. I'll give you one that shouldn't surprise people. Some things are just world-class, and yes, it's had a tremendous move from discovery to here it is, but do I think when the institutional world wakes up to the sector again, and it's starting to, I could tell you from over the last couple of years, from having friends in the industry who showed no interest to now wanting to pick my brain, or institutional allocators of capital who are now putting capital to work in funds that are doing this. They will find that some world-class assets, right? They're smart people.
Yes.
And so yes, that would be something that I'm comfortable to say that I do. Again, but what
Right.
I don't say is it a small position or a really big position? I don't talk about that. I do like, but that's one that I think is great. Now that shouldn't surprise people, right? That's
no.
But I also own a private uranium company that owns that has mineral rights in the United States.
Right.
Our fund does. So there's all different things.
Yeah, and people need to get that there's a time and place for everything, whether it's a liquidity of a New York Stock Exchange listed company, exploration play in Africa, the timing related to development stories in Africa versus Canada. There's always a time and a place for these types.
Andrew. And it depends where the market's mindset is at the time, right? There's a time where, look, the way I have the portfolio is I have really big positions at the top, and then I have a small bucket. I'm happy to have a small percentage of capital devoted to way more speculative stuff where I think the risk reward is significant, but there's a chance that something doesn't happen. And if I'm wrong on the cycle, those things are going to get pummeled, right? That's another reason why I don't like to say, I might like this name, but it could be a couple percent position, which means not a lot, right? That's how I don't like to talk about.
So asking, I don't know if you can share this or not with the what would you for Sachem Cove? What is give the audience an idea of a position size that you might use, percentage terms?
I mean, if I really like something, I'm comfortable at double digits.
Okay.
If something's really a flyer that's speculative, it doesn't have to be Sachem Cove. Just throughout my career and how I'll think about it, right? So it's not Sachem Cove specific, but if you think about how I take my view of managing is, you don't get a lot of shots at the apple. So you want to if you think you're right on something, you got to make some bets. So if you have really, if I in my past, if I have really high conviction, I'm comfortable at low double digits, maybe a little bit more. If I like the speculative nature of something, and these are all speculative, by the way. Even the best uranium company is highly risky, highly speculative. I don't care what it is. But something that's even way down on the thing, and it depends. Did I get warrants? Did I finance it? Right. So that plays
price.
into it. Right. Price.
Yeah.
What everything comes down to what you paid, and so small. Like I said, small can be 1-2% is how I've always thought about a portfolio. If I think that I have multiples and multiples and multiples of upside, I'm willing to risk that. And then I want to know how much am I going to lose if I'm wrong, because on some of these I'm going to be wrong. So that's kind of how I think through that. I'll tell you what I don't take the view is. I think there are some geographies that I'm comfortable investing in, and others might not be comfortable investing in. You talked about some of the African names.
Jurisdiction.
I understand that they carry guns there. I get it. I've spent a lot of time throughout my career understanding the geographies and understanding the risk and reward of that, and what how much does a country rely on that certain mineral for the amount of revenue it brings in? What's the likelihood they're going to do something stupid and change the codes real quick? But it doesn't mean I say no right away. I don't sit there and say absolutely not. I think there's some really very, very interesting values. Again, what's the price I'm paying for the risk I'm taking? So,
right, absolutely. So, moving on to some other topics.
Yep.
So, actually, on the topic of jurisdiction, Mike, give us maybe 2 jurisdictions that you like right now as far as timing goes.
So that's an open-ended question, and so as you can tell, I like to talk about uranium. So, look, I think everyone is focused right now. The uranium world is focused on Section 232, and the buyers of the fuel of the uranium fuel buyers, they're focused on Section 232, and the U.S. buys about 30% of all the uranium in the world. So go them, so goes the marketplace, and so people are the fuel buyers want to know, who do I have to buy my uranium from, right? So 232 will have some resolution from Commerce in April, and then Trump has 90 days if Commerce recommends doing something. The ask is for a quota of 25% to be bought from U.S. Fuel buyers. So you've seen a lot of people anticipating that to happen. That is something that it starts to get priced into stocks. I've had a lot of experience over my career looking at regulated industries. And looking at governments. I did a lot of work in the for-profit education industry for a couple of times in my career, a tremendous amount of work. And I understand that things happen. You can't assume with enormous conviction that because something is so obvious, somebody's going to do something. Right now, I think it is very politically popular for the Commerce Department to recommend something be done. If I'm Wilbur Ross, I probably don't want on my watch to be the guy that said, nope, forget it, let this industry just disappear. What that is, though, who knows? Right? The uranium mining industry is much, much smaller. It's a gnat compared to the electric utility industry. And the electric utilities are fighting like crazy, saying that we don't want this. We don't want to be told. We have the Kazakhs, the Russians, the Uzbeks. They've been great, responsible suppliers, right? You go to the comment sections at Commerce, and you can read this stuff. And, okay, I suppose. But I'm a big geopolitical junkie, and we're in Cold War 2.0, and we have been for quite some time, right? So you can make a really strong case for, the Uzbeks, the Kazakhs, and the Russians have been great suppliers, but hey, let's not kid ourselves. It is a geopolitical tool for Mother Russia. Energy is,
of course.
Right? So,
yep.
So what happens? Does that mean 232 is a slam dunk? Nothing's a slam dunk, right? Because you don't know what takes place in these with the horse trading that takes place, right? My guess, if I have to make a bet, right? So my guess is something gets negotiated. If I am a betting man, something gets negotiated that lets everyone kind of save face. That keeps the uranium miners going. It gives them life. It gives them some breath. The utilities can live with it, right? Again, and
agreed. Yep.
So I spoke. I told you I spoke at the NEI, the Nuclear Energy Institute, and I spoke to these fuel buyers back at the end of October. And I stood up there and I said, now I'm looking at 150 people who don't like me because they think that I'm telling the world whenever I speak about it that it doesn't matter. These guys, it's nothing. It's only a few percent. They don't have real issues. That's not at all what I say. And Andrea Janetta, who runs Fuel Cycle Week, the publication that is, the weekly publication that most of the industry reads, she and I have become friendly. But there was this tension in the air that I always felt, and Andrea would write in her commentaries, the dumb investors are in the room. They've seen this thing before, and talking. So after the conference, after I spoke, Andrea and I were chatting. We bumped into each other, and she said, "Well, why are you here? Why are you talking to these people? You're just a mouthpiece for the uranium miners." I said, "What? Like, what are you talking about?" And she said, "Yeah, you're talking to all these fuel buyers about costs and all this stuff, but you're really just a mouthpiece for the miners." I said, "Wow, we've never really spoken before, but you talk about two ships passing each other in the night and just like not knowing what's going on." I said, I'm a person who allocates capital to a mining industry. I'm the last person the miners really want to be talking to sometimes because you can't go out and play the pounds in the ground game with me. You can't go out and buy some bullshit pounds of uranium that will never see the light of day because you need to go out and raise money 6 months from now or 3 months from now, and you need to have something good to tell people that's really not good. You bought stupid pounds in the ground, and you went out and bought them so that you could go raise another $2 million to keep your lights on. And you added some debt to the balance sheet, and these pounds are stupid pounds. They're uneconomical. But unfortunately, for the last 6-7 years, you've been selling stock to retail investors who don't know what to look for, unfortunately, and unfortunate. And so you've been doing it to keep afloat and diluting the living daylights out of people. So I was talking to Andrea. I said, "You think they want to be on the call? Because now here comes somebody who's a institutional investor that's holding their feet to the fire and not going to give them capital for that, and is going to make them show discipline, and is going to say, you can't bring this online at $40 a pound because, oh, by the way, you could be telling the world that your costs are $25 or $30 a pound, but I understand what a C1, what a C2 cash, what C1 cash costs are. I understand all-in sustaining costs. Now let's go back and let's dive through. You could say in your glossy presentation your cost is X, but that's not the real cost to pull it out of the ground. Let's really dive through. You're putting royalties in there. You're adding back DNA. You're putting transportation costs in there. Let's really see what your costs are. Your costs are much higher. But right. During the depth of a bear market, when you need to raise capital, you got to make yourself look good. Now, it eventually shows up in the numbers somewhere, right? You can't hide transportation or royalties. But when you're trying to say, look, the market's at 23 or 25 or 28 or $30 a pound, we have really great costs. Look at us. Well, I'm still waiting to meet the first uranium miner that's not in the lowest quartile, right? Because they all say they're all in the lowest quartile. But the costs show up elsewhere on the P&L statement, right? And as I said to her, I said, you should be on the phone with me having some of these conversations. And she laughed, and we sat down, and I said, you got a minute? She said, yeah. I said, well, you want to see how I conclude all this stuff? She said, sure. Well, that lasted hours. We went into a little enclave at the hotel, and I fired up my laptop. I said, here you go. Here's my model. Here's everything. It all flows into it. Here's primary mine supply, secondary mine supply, Japanese utilities, every country by reactor. Let's do our underfeeding tab. Let's go in and let's look at all this. And here's the math. And here's how it all flows into the main model. And let's take a look. And here's my math. And here are the costs of each project that's going to need that to come online. And she said, wow, I didn't realize that. And so, it's an odd space. So as I think about Section 232, that's what the world is focused on right now. I do think that has you've seen the spot prices rise. So I think the equities in some of the U.S. miners have worked in anticipation of that. You always have to think, though, what happens if something doesn't happen, right? Because nothing is a slam dunk. I'm more inclined to think, like I said, it gets negotiated away. So how do you play the cycle? So that's part of it. Now what's kind of been ignored during that, because of the excitement, right? Vanadium's another thing that people get really excited about. I'll be clear, I'm in this for the uranium cycle. There is some vanadium as some of these mines have byproducts, and it could change the economics. But I didn't sign up to have a vanadium fund. But it can help on some of them. You just got to understand what you're looking for. You got to really drill down and understand when you're looking at these things that it's very common for companies to go chase hot commodities, right? To say, oh, we have this, and then the prices roll over, and you got to be careful. So you got to understand what happens if that happens. Can they still make a go of it, right? So you got to understand that stuff. So, but I think geography is right. I think what you've seen is if you stare at these stocks throughout the day and you look at them over a long period of time, you've certainly seen the market not appreciate some of the really higher grade stuff that you would find up in Canada. You've seen some of the African assets just be completely ignored. There are things, and depending on where you're trying to you have to gauge what the market psyche is, right? Is the market, I see it interesting now. There's been a decoupling the last few months. You've seen spot price go up to $29, but the last few months the equities have some of them have been pretty pounded. But what you could also see is some of the bigger names are hanging in there a little bit better. So if they're hanging in there a little bit better, some of the bigger names, some of the more higher quality names, that could tell you're starting to see some institutional bids starting to come into this space. You're starting to see the interest change.
So, Mike, you spent a lot of time looking around at these different jurisdictions and different folks in the industry, and you've studied a number of them and come to conclusions about various things. So, is there some names of some credible people that you've come to respect in the business that you want to share with us?
I've met all types. I've met some really credible people. I've met some very people I think are not credible. You've had a guest on that I have a lot of respect for, that I speak with, and that I think gives some really good insight into the industry. I'm a big fan of Dustin Garrows, who has been around probably 40-ish or so years. I think Dustin has seen a lot, and he's seen it all, he understands the cycle, and he understands what's going on in the marketplace. So I'm a Dustin's. There are. I prefer not to say which CEOs that I hold in high regard and those that I don't. That's just kind of my own personal preference not to say that. But I'd rather not go into the company management and stuff like that. But Dustin is somebody that I think I have a lot of time for.
Yes, absolutely. Yeah, Dustin's a great guy, and he like you said, he's seen it all. He has consulting agreements with various companies. He's been on different continents, so very, very interesting guy, and certainly he's probably forgotten more than we could ever learn.
Yeah, and for me, Andrew, whether it's the engineers or the geologists, I'm a sponge, and guys who have worked in the industry 20, 30, 40 years. Now, look, they're also susceptible, some of these people, from falling prey to, oh, God, the market's brutal, right? And not seeing the changes taking on their place. But when it comes to projects and the history of projects, and they're invaluable in trying to understand the history. The history is so important, right? Because you see some of these projects get recycled and recycled and recycled and being sold as great projects, and you speak to someone, they say, oh, Christ, here's why this isn't the case. So, yeah. But that is one.
So moving over to separative work units, SWU, as we like to say it in short, where do you see SWU prices going in 2019, 2020?
Well, it's something that kind of, I'll go back to when I started speaking publicly about this. It was something you weren't seeing people talk a heck of a lot about, with secondary supply, which didn't make sense to me because it was underfeeding SWU, underfeeding at the enrichment, which takes place at the enrichment process. You had a lot of excess capacity of separative work units at the time. When there was from the GFC, you had some demand came off, Japan went offline, that whole thing. Everyone knows that story. But you had excess capacity. And the price of SWU at one time was as in the high 100s, 180, 190. As you started to see it fall and fall and fall and fall and fall down to, it was going into the low 30s at one point. And, enrichment plants are in the business of enriching uranium. That's how they make their money. Underfeeding is just something they do that they can wring out some extra enriched uranium product and sell into the end market. But at one point, that was upwards in the mid-20 millions of pounds that it was adding to the market. But when you start to look at what goes into some of this stuff, and you look at where you start to run into design limitations of the centrifuges, the Western centrifuges can go down to optimal tails assays about 0.18-ish, and the Eastern, the Russian centrifuges can spin optimal tail assays down to about 0.1. And when you blend those two, the market share of 10M or 10X, the Russians, and Urenco and Areva and the Western guys, combined, the Russians have half the market. You start to get into an optimal tails assay of like 0.15, and that's where you're at right now for the industry. So we started to look a while back and say, well, we're starting to see SWU settle in here in the high 30s, and as we start to think about that, and you start to say, okay, well, they really can't drop these optimal tail assays blended market share wise that much lower. So we think that that's going to start to have an impact on where prices start to stabilize. And really at those levels, we felt as though that the enrichers weren't really making money at $35, $37, $38 SWU. And, we knew excess inventories were being drawn down and working their way through the fuel cycle. And, you start to see Converdyne close and the converter. They put the conversion market into deficit, which resulted in conversion prices doubling. and you've started to see higher U3O8 prices. So when you add higher U3O8 prices and higher conversion prices, that equals higher UF6 prices. And, U3O8, uranium, right? Conversion are the inputs to UF6. And so one of the last major stops is SWU for the utilities. And so as we think that, you're probably at the lowest optimal tails assays you can get, the order books from these enrichers are rolling off. They signed contracts for SWU just like the miners do for uranium. So as these order books are rolling off, they're not excited to go out and sell $38, $40 SWU when they were getting well over $100 for their separative work units in the past. So from a design limitation standpoint, from order books rolling off, they're not going to go sign contracts there. And so, our view has been that it's going to SWU pricing will start to move higher, and I think you're going to start to see it move higher throughout 2019 and 2020 is what you're going to start to see. And I basically, enrichers are in the business of enriching, not underfeeding. They make much more money enriching uranium and selling it at those prices. They want to be running capacity for primary utility contracts, right? That's what they want to be doing.
Yes.
So as we think about it, and I spoke at this NEI conference, and when you were up there, they stood up there, Urenco and 10M, and they started talking about it, and they basically said, look, we're working down our excess EUP inventory as high as the market believes. They said as UF6 and SWU prices change, the optimal tails are going to change too, and one of them said we're only really underfeeding to the extent that we fund some internal research and development. It's not our core business, and they had done a consensus view of the room beforehand. They had polled people, and 90% of the room thought there was all this excess SWU out there. So it's I am of the view that underfeeding in 2019 and 2020, the amount of pounds that hit the market will start to materially decrease. And I told a few buyers that when I spoke to them, and then afterwards, Urenco and 10M were up there not disagreeing.
Okay.
During their presentations. So I think that's been I think that's underestimated.
Right. Okay. Well, very well. I appreciate the comments and the views on that. Speaking on the same subject, just kind of came to my head here as you were talking. Maybe you can share some views on this one, because this one's a really odd one, and I believe, and we might be a little bit behind in our ignorance, but Centrus Energy is a listed company. Used to be USEC. What's your thoughts on this company?
Well, they're really a SWU broker right now. They're a broker of SWU, and they have done some work with the new technology, right? So they have done work with the government for newer generation technology is what they can for enriching, right? Because if you think about it, the U.S. does not have any of its own enrichment. So if
right.
you just step back and say, okay, well, this whole 232 is because on the grounds of national security, the U.S. miners are going to go out of business. Okay, well, that's cool. Centrus used to run the gaseous infusion plants in Paducah, and those closed. Those have been closed for years now. So the only enrichment, which is the important part of the fuel cycle,
yes.
It's right, uranium out of the ground can't power anything. Well, it can for the CANDU reactors, but there's only a handful of. So you really need enriched uranium for the bulk of the reactors around the world, and so So when you start thinking about that, in the U.S. the only live enrichment is 5 million units of SWU in New Mexico that's owned by Urenco, which is the English, Dutch, and German conglomerate, right? So we don't own it, so Centrus came out of Chapter 11, right, as part of that USEC thing, and with the Department of Energy, they developed a centrifuge technology which is known as the AC-100. Right, so the the AC100 is a really pretty cool centrifuge technology. Now, to build one of those, there was a report in 2015 that the DOE did, and they estimated that the cost of the plant fully equipped with the required 1,440 AC100 centrifuges would be $3 to $5 billion and to build. But if they delayed construction to like 2022, it could swell to like $11 billion. Well, it's not being constructed right now. The interesting part of that was an AC100 plant built just to meet defense needs, because you got to separate defense legislatively. You've got to separate defense and commercial needs. So if you were to do that, the estimate at the time was to meet the defense needs, they would produce low enriched uranium at cost ranging from like $270 to $618 per SWU. Think about that, costs, right? Now, if you think about the historical market price of SWU on average over time is probably about $100 per SWU. These guys' costs would be that much higher. But it'd be done for government purposes. And so it's not done, and it would only be for much smaller amount. It would be for 400,000 units, hypothetically 400,000 units of SWU per year. So it's. You've got to really understand, right? And you would think, okay, Centrus has this advantage should the DOE decide to solicit bids and build their own enrichment plant. But the DOE holds the intellectual property rights to the AC100 technology, and they could license it to another contractor. So it's not so cut and dry. Now, I don't have an opinion. I don't own it. I have no skin in the game on it, nothing at all. It's at all. But so they really right now what they do is a SWU broker. Could they be in the mix? Should enrichment become, hey, we got to enrich here in the U.S.? Yes, they have they have proven. They have done tests over a 3-year period, and it works. It really does work. So it's good. Oak Ridge Lab also has a separate enrichment technology that uses smaller centrifuges, and I think in that DOE report they estimated it would cost something like $3.5 to $7 billion to build, with operating costs similar to those of the AC100. But that hasn't been those. Haven't been tested yet, and a lot of this has to do. This has to do with Department of Defense needs, is what we're talking about. So, anyway,
it's certainly an odd duck, that particular business, and their bonds in the market and so forth, and even watching what the stock does. So it's interesting. On kind of the same grounds, just a little bit. Just what's your thoughts on Lightbridge's fuel technology, and do they have a fighting chance to get their fuel into commercial reactors on a wide scale basis?
They're just unfortunately they just keep disappointing investors. Again, another one I don't own. I'm aware of it. I follow it. It's high assay, low enriched uranium, right? So assays upwards of the 20%. They've got one of the research reactors they were testing in wound up closing, and they were just going for a research grant to get some money from the DOE, and that got knocked down. They're going to revisit it and go back to it. And the theory being is it burns at much lower heat rates, so that you could avoid a meltdown type of thing. You could avoid having some of the backup systems that you need, which could lower the costs. They've had there's the big 4 of the big utilities in the U.S. have supported them, and they also have their Framatome agreement, which is the Areva thing, or Rano, whatever they're called now. Do I think in the I don't want to say what I think the timeline is. It's much, I think, more elongated than not. I think investors were disappointed when they announced their JV with the French back earlier in the year, that it would lead to all sorts of stuff and financial commitments, and it really didn't. But it did give them access to Framatome's technology and their know-how. I think people are looking for more of a financial commitment, and I think the stock can run up to $4 from under $1, and now we're where does it sit? Like 70 cents or something like that. So yeah.
Okay.
I don't have capital committed to either one of them. Not saying that I don't think they're interesting and working on
Sure.
good stuff, but it's just not where I've committed my capital.
Yeah, absolutely. And just from the technology side, it's interesting to see how that might play out, their methods and how it might go into maybe SMRs and, the leadership there.
Absolutely. Well, but because the SMRs would use the high assay, low enriched uranium, right? So, and
right.
I believe SMRs have a promising future. So yes. Yep.
Yeah. Okay. So on another topic, give us kind of your, if you will, just kind of briefly, give us kind of your secret sauce to your approach to evaluating a uranium explorer, a producer, and a developer. How do you look at these from both a risk perspective, downside, of course, and how do you measure the potential upside? And give us some brief topics, points.
Sure. And again, this comes back to sizing. Like am I going to have a 1 or 2% position where I think it's they have a large land package, they're in an interesting basin, they're in the neighborhood of of where there's been some other projects that have been successful, but they're still very, very early stage, and they have some smart people who have proven success in exploration, and there are some reasonable opportunities that can, through further drilling, there can be something. So really early stage. I want to understand like neighborhood, location, geography. Have they done it before? What's that type of stuff? But those for me are flyers. Those are smaller positions. When I'm looking at a bigger project, I don't look at these things and say, oh, look, EV per pound in the ground, we're 40 cents, we're cheap, we're 60 cents. Peer group is $2. It's meaningless to me. In situ value is meaningless to me. I want to know, you've got all these pounds in the ground. If you go back to what I said earlier, a lot of these guys bought pounds just to go out and raise money, and to have news to tell the market. You want to understand so I look at each project. What is the project? I read I'm going to read the pre-economic assessments, the pre-feasibility studies. I'm going to look at the assumptions that went into those. I'm going to run those by the people I trust that understand this and see if they're reasonable, see if the geology is reasonable. I want to understand are the costs, how dated is the study? What has been the mining inflation that goes into it? And that's something to think about as you think about the costs of many of these future projects that are out there that have known resources in the ground. They have measured and indicated resources of X. When was that feasibility study done? Are they going to have to be competing with drill rigs that are being used for shale plays right now? Right? If you're in the U.S. and you have a project that could come online and you're doing ISR mining, well, you're going to be out there competing for drill rigs against guys who are in shale plays, right? That's a meaningful cost. Are you going to be able to get the labor out there to do this? So it's really piece by piece going through the feasibility studies, going through the pre-economic assessments, and then I want to understand: are there byproducts associated with that? What is the milling cost? If I'm looking at the economics, let's say, of somebody that needs to do a toll milling agreement, that has a project, I want to know the cost per ton to mine it, the cost per ton to toll mill it, the cost per ton for G&A at the project, the cost per ton for transportation. And I want to understand if those make sense. How many miles is it from where they're going to be shipping it? Does that transportation cost make sense? Is it reasonable? Are those mining and milling costs in line with what others might have? Is there anything that stands out that would make that unusual? Are those assumptions too aggressive, or are they too conservative? That type of stuff.
Yeah, so, absolutely, and
then I want to look at the cash flow of that project, right? So, what's the cash flow that's going to generate? What's the present value of those cash flows? And right now, nobody cares on some of these projects because people don't ever beat the market collectively doesn't believe they'll come into production, right? So at this point in time, it doesn't care, but they will care. But I'm really careful on the EV per pound in the ground game because that's a way to get sandbagged pretty easily.
No, you have to look at a lot. You have to look at the G&A. How responsible are they on that side? Is management funding their personal lifestyle and just minding the shareholders? You have to look at those things. You have to look at what is the shareholder structure. Does the Chinese own it? What's the what is it? Is it already been
absolutely? What are the royalties on? So you could look at some of these, right? Is it a Department of Energy lease where the royalties, if it's in the U.S., the royalties could be 20, 25, 30%? Right?
Right.
Is it a Bureau of Land Management lease where they're not paying a royalty, but they're paying a maintenance fee each year? They're paying $400 to $412 to stake a claim, and then they pay an annual maintenance fee on it. Is there a royalty attached to it? And that's when you're looking at all these reports, right? Understanding the cost structure is something that I think people need to spend a lot of time on, and I'm not sure. What do I know? I just look at stuff on if I'm seeing the Twitter banter that goes on that is always going on. But you really need to understand what you're looking at when you're looking at cost, right? Is it a C1 cost, your cash operating cost? That's a direct cost that includes there's blasting, mining, drilling, for ISR projects, the hauling, the milling, the processing. Does it include freight and marketing, right? Because you're paying all those costs. Are they showing you the total production cost, the C2 costs, right? That's all your cash operating costs plus your D&A, right? Are they showing you an all-in sustaining cost, which is your C1 and your C2 costs? Now you're adding sustaining capital expenditures, which if it's an ISR mine, it could be significant for stripping and sustaining all of that development that needs to be done every year, right? And then you want to get a fully allocated costs, right? Does it include future project exploration, right? Does it include the indirect costs and the overheads, taxes, interest charges, loan repayments, right? So you got to understand what you're looking at with all this stuff.
Yeah, you have to look at the infrastructure. What's it take to get? Do you have to bring in power lines? Do you have to? What's your energy generation going to be like in some of these places in Canada? What's the red tape cost? What about the sovereign nations? You have a huge community outreach cost. You have so many of these indirects that nobody really thinks about. Yep. And so hey, how are we gonna get that $1.3 billion? To get this thing going. So yes, it's interesting. Investors and speculators alike need to take a hard look at all of the aspects related to these companies before they even give them a dime. I mean, you have to have a hard look at it, and then proceed with caution. So anyway, good points you brought up. So moving on, Mike, you've given credit many times to your in-house uranium model. With your model and current factors in play, and also some of the changes that have happened in the last couple of months, when do you realistically see a severe price upside in uranium to occur?
Well, I think when 232 clears, whatever the outcome is, when Section 232 is known, what the outcome is, I think you'll start to see utilities start contracting at a very meaningful pace, and I think they're going to be paying much higher prices for the uranium on term contracts. So, April timeframe, I would, sometime later, and I think the market, Andrew, is ridiculously underfollowed, and for me, like I've said this before, it's the biggest disconnect between price and value, fundamentals, and what's actually taking place. The supply destruction that is taking place, the new projects that will not come online and are getting delayed. And 2020 is, you could say by 2020, a third of the utilities don't have their uranium contracted for, and that waterfall just falls precipitously. And look, the reality is, These projects are not coming back online. A standard comment I hear as well, at $40, it's going to start flooding. Well, flooding the market with all these closed projects. I laugh at that because it tells me people haven't done the work. Because all of these closed projects, what are all of those closed projects, right? Does it factor in that Cominac and Samir from Orano in over the next handful of years are going to be winding down, which are the Orano projects in this year? The Chinese just bought Rossing, and so they're going to use that uranium for themselves. If prices recover to the point where, because there's only really one more contract there left, Cameco, you could talk Cameco. As Cameco, it's convenient, the low prices for Cameco, to be saying that the price of uranium is why they've shut down MacArthur River. As they start mining into other zones, and there are more challenges. It's more expensive. My call on Cameco is I don't think you see MacArthur River come online till you're well into the $50, $60 uranium because of cost factors there. The Kazakhs, when you look around the world at the Kazakhs, they've dramatically underspent over the years on their capital expenditures and in the type of mining that they do, the in situ recovery mining. It's a very big depletion curve that CapEx needs to spend significantly. So, I think that their nameplate capacity is 70 million pounds, and they'll produce 55-ish or so, 54-ish or so. I think that goes the other way, not the higher way. So, as I think about, and the utilities are smart. These are not dumb people. They have had a perfect storm where they have not had to go out and enter into long-term contracts because of the structure of the market. And I think that gets so overlooked by those giving a cursory look to the market. Is, as with after Fukushima and demand was slack, obviously, and you started to see these contracts roll off. If you go back and look at utilities and when they were buying long-term contracting at the peak. That's because they were worried about supply. And so 05, 6, 7, you saw the volume of long-term contracting go parabolic. And as you started to see that, well, as they started to roll off, you were in an environment where you had the global financial crisis was still reeling. Demand was, electricity demand was weak. The Japanese were still offline for the most part, and you had these big trading firms. It started with a couple of the big investment banks that would go out and say to the utilities, "Listen, there's a lot of uranium out there, right? You had excess mine supply. The miners should be ashamed of themselves. They were increasing production throughout this downturn because they assumed Japan would come back online quicker than it did. I don't think they calculated underfeeding to the extent that it occurred in their views. So they were increasing production every year, increasing capital expenditures, which was crazy in 2012, 13, 14, 15, 16, mired in this brutal slump. They were looking at the end of the megatons to megawatts program, where it's 20 million pounds from Russian interballistic missiles being downblended from HEU to LEU, which is reactor type nuclear fuel. And so they looked at that and said, well, this is coming to an end. So we're good. The contracts will roll off. They'll enter into new higher prices. Well, a couple of the investment banks said, you know what? The DOE substituted not all 20 million pounds, but the U.S. DOE started selling uranium into the market to the tune of 7 million pounds a year, 7-ish million pounds a year, and underfeeding was really accelerating. And the bank said, don't enter into long-term contracts. Why don't you let us enter into shorter-term contracts with us, 1-2 year contracts. We'll go out and secure the uranium, and we'll charge you a fee for it. And it's called a carry trade. And that hadn't really existed. So the utilities said, okay, yeah, well, that makes sense. You mean we don't have to commit? Yeah, you know what? Demand is kind of weak and there's a lot of excess supply. So let's just hang out of the market for a while. And that kept happening and happening and happening. And then some of the traders got cute and they went out, and rather than going out and covering their own needs to those contracts, They stepped out of the market. Hey, we'll sell you 5 million pounds a year, but we might not go secure that 5 million pounds. So you start to develop a short position there, and then things change, right? So anyway, so when does it start to turn? Look, I think based on my model, that I think that you are in the tens of millions of pound deficit for the next several years. So I think that when Section 232 clears, the utilities start to come into the market, and I think you start to see pricing, long-term contracts start getting signed at much higher prices.
Right. And just a couple follow-up quick answers here as we get through the topics. I see the same thing. So for us, the key catalysts at this point are the 232 outcome, and then the obvious elephant in the room catalyst is the long-term contracting. So those are the two catalysts I see that are going to punch this thing forward.
And one's dependent on the other. They're codependent.
That's correct. And so with looking at your model, just briefly, maybe you can give us a little bit more information. Do you have a count of how many contracts by year, by country come off, and the rough volume that needs to be recontracted by the year?
Well, I mean, if you want to go back and think, yeah, I mean, I do. Am I going to share it with you? No. I think what I'll say is a third of their needs for 2020 aren't under contract. So it ranges 30 to 35%. You could get comfortable in that number, and you could do that
annually?
by looking. Yeah, annually. Yep. Well, no, it accelerates from there because the waterfall keeps escalating, and as you get into 2025, you're pushing north of 60% as you start to get 2023, 4, 5, and you got to remember this is a time period where no new projects are being developed, right? So, I mean, I put up a slide at the Nuclear Energy Institute conference of 30 some odd projects that I put up there that show the feasibility studies that require at least a minimum of 50, and they're full of shit. They need more than 50. Most of these projects need $60, $70 uranium to come online.
Right.
And that's going to fill that to fill that void, and so the consensus view is, like I said, it comes back online at 40. Nonsense. I think it needs, supply comes online at least at 50, maybe. But and then you start staring out into 2027, and Cigar Lake runs out. 18 million pounds a year. That's gone, right? And then so what's the big beautiful project out there? World class next gen, the Arrow project, that can put it in the mid 20s, maybe a little bit higher per pound. These are responsible, real, sharp guys. Their project is based on $50 uranium. Yeah, they have $11 costs on an all-in basis. But first of all, you don't know when the project will actually get permitted and built. So maybe some will say 2023, 24, 25, 26, 27, right? There's all this speculation as to how long the permits will take. Who knows? But then you got Cigar Lake coming offline, and when you're talking a year or two difference here in the world of uranium, I mean, uranium moves in dog years. That's how long it takes to get this stuff done. And so, people like, well, 2027, this is happening, and 2025, it's all the same. These guys aren't going to flood the market and hurt themselves. They could. They're going to price certain contracts at fixed prices, and then they're going to expose themselves to market pricing on the others, and they're going to gauge how much they bring online. But in the interim, there's a big white gap of space, of a gap between primary, secondary, and demand. And I'm not even factoring in the hundreds of proposed reactors and stuff out there, right? So yeah, I think that I think that you are at the cusp of severe supply deficits, and utilities. I was going to say the utilities at a third not having their needs covered. I think that only just escalates dramatically from there.
Very, very well. What we wanted to ask, and it's a very interesting piece of information, and it would take a lot of effort and a lot of time talking and trying to find these contracts and putting together a model for these contract expirations.
No, but we have them. I mean, you can see. I mean, by year, we have by year how many pounds were contracted in the spot market, how many pounds are in the long-term market by year. So that you can do that. You can do that work, right? Since Fukushima, you've had what, 1 billion pounds come off term, replaced by 350 million pounds since, right? So you've got a wedge of 650 million pounds that haven't been purchased.
Right.
So I mean, that's a big
wedge.
Look at
and there's some different research outlets that have some good, not 100%. I mean, you can't talk to the utilities directly to get the 100% information, but there's a lot of information you can piece together and come up with a very, very accurate figure.
Yep.
Okay, so moving on, couple more short questions and a couple topics to give some short answers on. So on secondary supply, you've probably done more work on secondary supply on the investor side of things. What is your view on underfeeding in the years ahead, and when do you see that it would be attractive for underfeeding to kind of get going back again?
It's never attractive for them to underfeed. It's a survival technique. It's a cash generating technique. It won't. As demand picks up, they're going to be enriching and not underfeeding. So that it doesn't become attractive for them. They don't sit around and say we want to underfeed. They sit around and say, okay, well, shit, let's underfeed. Let's do that because we're going to generate with this excess capacity. We're going to try and generate some cash flow from it. So it's not.
Okay. Yeah, and it's good to make sure people understand that. So that's the question. That's why the question came along, and I think some people are confused as to this some of the secondary supply sources and kind of how the underfeeding works. I mean, obviously high prices set in a bunch of other issues that come along when uranium's at $90-$100 plus a pound.
Yep.
So will the recycling of depleted or used uranium be a potential secondary supply source, and is it substantial enough to matter?
Probably talking mocks or some recycled tails. There's a pretty steady amount of that comes into the market every year. You could if you were modeling it out, you could pencil in between 5 and 10 million pounds, and that's pretty steady. It gets very expensive to do that, so that's a pretty steady, consistent number. So no, it's not something I would expect.
Okay. So another topic that came up: if the Japanese have been honoring their long-term contracts for uranium post Fukushima, wouldn't the Japanese restarts be irrelevant from a demand perspective over the next 4 to 5 years?
Yeah, I mean, I think that at $29 uranium, that's well priced, and I think we've moved past that. I mean, I know there are commentators out there that say, well, it's still the Japanese restarts. Come on. Japan has 110 million pounds by accident because they didn't want to, right? And then you look at, how much of that is fabricated fuel, right? There's a big chunk of that's fabricated fuel, probably half of that. And that's not fungible. You can't use it in different reactors. So really, you're looking at mobile inventories, and what's mobile inventories? U3O8, UF6, EUP, and as I looked at, 40 million pounds. Well, look how much, it's not a lot. No, and as you look through, Japan and what's running there, right? What's running and it's going to buy Kansai, Yushu, Shikoku. They're up and running. You got 8 utilities that are not running that have some inventory. But the ones that are up and running, I think you're going to see come back into the market. If somebody wants to do a really fun exercise, go back to 2000 and model out in-process fuel and fuel in the reactors. Look at the Japanese balance sheets of the utilities, which is what we did going back all the way. And you'll see periods of time where inventories are in the 10, 15, 18 years. So it's another number that people just talk out their ass when they're talking about Japanese inventories. saying, well, they have all this inventory. Okay, well, go back and look historically and see how much they keep around, because they don't produce any uranium in Japan, and so see how much they're comfortable with, right? So, yeah, it's so I think that the Japanese restarts, they help. We factor in a few every year. I mean, it doesn't matter. You're using 500,000 pounds at a reactor, 450,000 pounds at a reactor per year. So if they come online or not, with what we think is the tens of millions of pounds of deficit isn't going to matter.
Well put. Tend to have that same agreement with you on that. And Japan's an island nation, and they've had a historic record of keeping plenty of stockpiles.
Totally. Yeah, it's the same argument we hear on the Chinese are never going to buy uranium. Well, they've what they've bought. They have 400 million pounds. My God, look at how much they use. Well, the Chinese, the Japanese don't dip below 10 years. The Chinese aren't either. And if you look at the growth of reactors, we went back and looked at from 2000, how much they bought, how much they consumed, and how much is coming online over the next several years from the reactors in construction, and what's a reasonable amount of uranium that they're going to keep around. It's not 5, 7, 8 years. It's more than that. And if they were to just draw down from what they have right now, just over the next 5 or 6 years, you'd be down to a couple of years, 3 years worth of inventory. They will never let themselves get in that position. They were never going to be dependent on anyone else. So we think they're in the market buying 20+ million pounds a year. They have this Husab mine in Namibia, which they bought back in 2014. The world thinks they're producing 15 million pounds of uranium per year. They're lucky to produce a couple of million pounds, maybe a few million pounds. They'll never do the 15 million pounds capacity. That nameplate capacity is going to be coming down probably to 10 million pounds nameplate. And I don't think they ever produce more than 7, 8 million pounds a year from that. And so they went out and bought the Rossing mine, and the Rossing mine is long in the tooth. It has some other zones that they could go out into, but they're a net buyer of uranium.
Yes. So we already kind of covered this, but I want to reconfirm the closing of U.S. reactors and the planned closing. It has no impact on this cycle.
Yeah. So we take out a number of reactors throughout our forecast period. Check, and we do that, right? So we do it by reactor, and those who have seen my model know that it's we're very comfortable. Like I said, we went draconian on France in our forecast period. The French recently came out and said by 2035 they'll go down to 50% dependency on nuclear power, down from 75%. So 18-ish reactor. I don't have my model open, but from memory, it's 18 reactors. That number would be, I think. We took that out in our forecast period starting in 2016, 17, and building the models. We took those things out by 2025. Check, got it. Got the U.S. reactors coming out hard.
Yep.
Yeah. So and I see that, right? Obviously, I'm sure you do too. Being a public person on this space, I'll get somebody email me something saying, "Oh, look, this reactor's closing." Aha. Okay. Geez, thanks, pal. You got me, right? Or somebody will tweet me about it. Oh, holy cow! Didn't think of that one. So yeah, no, those are in there.
Right. And yeah, it's funny. And 2035, that's what they said a few weeks ago. Wait till the protests get done.
Yeah. Oh, exactly.
Exactly. They decide to change that.
Yeah, they're protesting because of high fuel costs and energy costs now. Yeah. Good luck with that. And we did the same thing on South Korea, right? Because President Moon doesn't, he doesn't like nuclear power. We took a bunch of those out too. They're not going to do that, but we took them out.
Yeah, he doesn't like a lot of things, but looks like he's coming back around even with North Korea. So I think that'll change. Taiwan certainly, and with the current administration in the states, and with some of the recent state actions to prop up these some of these reactors.
That's something too. Is we take the U.S. reactors out, but I don't think a lot of those will close because I think they'll get the state support. Interestingly enough, pretty funny. Natural gas has been $2.50 forever. All of a sudden, it's $4.50. Yeah, I know the shale plays are pumping it out like there's no tomorrow. But imagine it. Imagine if natural gas was actually a natural resource. because apparently it's not, because people assume it's 250 forever, and assume those recovery rates are really as good as the shale plays as people think they are. And imagine that they just didn't have those depletion rates as they are. Imagine if there was something that just caused natural gas to spike up to the $5.50, $6. It's at $4.50. All of a sudden, at 70-80% of the cost of running those natural gas plants, all of a sudden that gets flipped on its head, and
that's right.
Zero is talked about when it comes to that.
Right, and the only place that nuclear plants are getting shut down in the states with absolute certainty is the crazy state of California.
Well, yeah, and also right where you have competitive markets. In regulated markets, look, they go to the Public Utility Commission when and they get their relief, right? In the case of the uranium guys, they have fuel riders in the regulated states. They go to the PUC and they get increases, and it costs the ratepayer a little bit more, but it goes on. In the competitive markets where they're competing with natural gas, then it's hard. But you're seeing the states start to step in and try and help them.
Yes, absolutely, and it's positive, and I don't think the sentiment is starting to turn there, and I don't see it going back the other way at this point. So
totally.
Let's see what else here. So on another topic, this is probably a simple answer. Is Cameco the only producer that is buying on the spot market, or are there other producers that are getting in on the spot purchases at this point?
The meaningful ones. I mean, I think Peninsula's bought a drop for what they're doing, but they are really in terms of the producers. Yeah.
Okay. Mike, so give the audience, for the folks who really don't know very much about this supply chain or chain of custody that happens. Give the audience a complete chain of custody ownership from the mine to the reactor. So kind of just give us a quick quick run from the take in the can all the way to the fuel.
So the utilities like to contract at each stage of the fuel cycle, right? So they like to contract with the miner, contract with the converter, contract with the enricher, contract with the fabricator. They like to control all that. So the way it works is they pull the uranium out of the ground, they process it, they mill it, and they turn it into yellow cake, and they put it into drums. They dry it out, and it's yellow cake is what people commonly know it as. It then gets sent to a conversion plant where it gets turned into UF6, which is in a gaseous state. And then from there, it gets sent to an enrichment plant where it gets enriched. So it's not fissile when it comes out of the ground. So they enrich it for nuclear power. It's typically 3 to 5%, and then for weaponry, it's above 85, 90% for it to be a nuclear bomb. Most of the uranium that comes out of the ground is used for nuclear power. And some for weaponry, and then some for medical needs and stuff like that. And then from there, it gets sent off to a fabricator that fabricates and puts it into fuel rod into the fuel rods. It gets fabricated and then sent off to the reactor. That cycle can take 18 months, can take a little bit less or a little bit more.
Right, and so for the beginners out there and the unknowing public, again, this stuff coming out of the ground as an ore is not dangerous. It's not going to melt your eyeballs. It's not this fuel in a plant under a meltdown scenario. It doesn't mean a nuclear bomb goes off and Florida's going to explode if the hurricane hits the power plant.
Exactly. It's not. You get as much radioactivity on a 6-hour flight from New York to LA.
Yeah, absolutely. Go out here, especially in some of these countries closer to the equator. Come out here and stand out here in the sun. You're going to get more radiation from the sun.
You'll get plenty of radiation there. Exactly.
And if you're in New York in the cold, guess what? Don't be talking on your cell phone too long, because the exposure might be a little bit more than what you'd get at a mine. So you got to understand some of that.
Totally.
So moving on. If the nuclear business only involved utilities and miners, would a secondary market exist?
I'm not sure I understand the question. No, because your secondary market comes from enrichers, right? So the only reactors that could run off of natural uranium are CANDU reactors. There's only a handful of those around. They started out of Canada. So you need to enrich uranium, and So the enrichers, right, it's a big form of secondary supply, has been underfeeding, right, which is the process at the enrichment level. The other sources of secondary supply would be the downblending of highly enriched uranium from weapons, which we saw from 1993 to 2013, where we saw about 400 million pounds come in from the Russians into the U.S. So that's a source. The recycled uranium, mixed oxide fuel, is another source. The Department of Energy at one point was bartering some uranium to some contractors that were paying for a cleanup. And then really your other secondary source is really some inventories that get sold into the market. So no, it would still exist.
Right, exactly. And I think this person might have meant that if the utilities actually controlled the enrichment, the conversion controlled everything.
Oh yeah.
But you'd still have it.
Yeah, you'd still have it. You would. Utilities used to be in the mining business. That didn't work out very well for them. So they've tried to vertically integrate, but that wasn't a win for them.
Sure. So Mike, switching gears regarding the big broad market, how do you see uranium equities holding up under a broad market bear? How likely are we to see this scenario come during this uranium cycle?
Yeah, I think that will depend on where you are in the fundamentals, right? If today 232 is happening, if 232 is cleared up today and contracting was signed, I think it would, the fundamentals would far trump what's going on in the overall market. Doesn't mean some wouldn't get hit. Right now, you see it now during the last couple of months, October, November, the market's been choppy. The crappy little junior miners, and I say crappy meaning I don't mean that derogatory, just the small ones, the tiny ones. There's some of these things trade $20, $30, $40,000 a day. Bob's sitting on his couch in Manitoba who wants to sell some stock because he wants to do something, can move this stock down 10%. And if the markets are getting hammered, some of these are in some of these indexes. You see them get sold, and when there's risk off, miners is still perceived by the market in a bear market, they're going to get hammered now. So yeah, you've seen some of that take place over the last couple of months. But I think as the cycle keeps wearing on, and as the fundamentals, and 232 being that big guidepost there, and again, whatever it is, if nothing takes place, it's going to hurt the U.S. miners a little bit, right? Those stocks are going to get hit. But then again, when you step back and look at the supply demand or the supply deficit, I think even they're going to do fine too, because you're going to need all the uranium you can get. But sentiment wise, it might hurt them. But as you start to see, if you start to see a $50 contract signed, I don't think it's going to, on that day the market's down a few percent. I think you're going to see sentiment change pretty quickly.
Yeah, it'll be interesting to see how this one plays out, because you kind of got a couple different points of research. Is the kind of the double pump that happened in the last uranium cycle. You had the global financial crisis knocked it was already up high, knocked it down, and then it went up again. So you had a double pump. And then if you look at 2001, 2002, sentiment during that bear cycle versus the 2008 crash, you can go back and look at a chart of Cameco in 2001, 2002, and how it responded to the broad market. Very, very interesting how natural resources responded back then.
Yeah.
So,
and it's like anything, the market's always searching out a bull market. And if the fundamentals warrant a bull market, I think you're going to see a bull market occur.
Right. So comparing to the last, go ahead.
No, go ahead. Sorry.
Comparing to the last cycle, you've seen this. You saw the fundamentals back then. You've researched them. This time we have. Yeah. Are the fundamentals this time the same? Are they worse, or are they better?
They're so dramatically better, it's not even close. In the last cycle, you had 23 reactors under construction, and 20, 30 million pounds of new supply coming online. In this cycle, you got 56 today under construction, and there's no new mine supply. You had Salamanca that could have come online at $40. And now you've got the government and all the negativity there with not granting all the permits that they need. And then after that, you are at these pre-feasibility studies that are these bankable, these feasibility studies that are out there, they need $50, $60, $70 uranium for anything to get started. So, and then you've got the underfeeders, you've got the enrichers not making money at SWU. They're not going to, their inventories are tightening there. You don't have those sources of secondary supply that were there. The U.S. Department of Energy pulled off the uranium from the market. So I think it's a much better backdrop.
Yeah, be careful with those countries that have a interesting sentiment, a significantly perverted government, and also with that, look out for the places that don't have the uranium framework. Has the country ever exported before? That's a big question.
Sure. Yep, absolutely. Yep.
So, okay, moving on here. So there has been a recent, trend of delaying shutdowns in place, like we just discussed. France, Taiwan, even in the U.S., like we've discussed, and even now, even starting to pick up in Germany. So how does the Mike Alkin model look, and how does the supply-demand situation look now over the next decade?
I keep them in. I keep the closures in because, like I said, we're in the tens of millions of pounds. So starting, 2020-ish. We're in deficit now, I believe, and then it starts to get worse. So you got to remember, a reactor uses 500,000 pounds a year. So if I keep them in the model, just to be conservative, that's fine. But it would only get worse, and that's I think one of the things I think that is a big misunderstanding is people play this as though it's reactor by reactor, by this, by that, by that. It's huge. It's huge. There's not enough mine supply to meet the tidal wave of demand that's coming, and that's kind of how we view it.
Right.
So it's split. So, people try and split hairs, and I think and lose sight of the bigger picture.
Right. Absolutely. So what has happened in the spot market? There was a lot of volume this year. Where is it coming from, and do you see kind of the same volume levels in 2019 in the spot market? And if so, how will the price react in 2019?
Look, you got buying from a variety of players, right? You've seen new entities enter the market that have come in. That some are, you've got the publicly traded yellow cake. You've got private investors. I know some large investors that are buying physical uranium. You've got some producers, obviously Cameco that was in there. Then you've got, the physical traders who trade in the midterm market. They'll generate some spot volumes as they cover. And then, utilities poke around a little bit, but, it's these entities that are coming into the market that are also sopping it up.
Right. Okay. So with on the same kind of question there, with the various uranium holding funds accumulating supply and with a large production potentially entering into the market at above 50 per pound, do you see demand being satisfied around these levels? And will these funds start to monetize a little bit of their holdings?
No, I don't think so. I think it's going to come down to going back to what I said earlier. People assume the restarts will just. People assume the given in the market is that the Kazakhs can pump out all they want at $40 because they have lower costs. I'll go back to the Kazakhs floated 15% of the company public. A third of it was bought by the pension plan of Kazatomprom of Kazakhstan. Other interested parties received a chunk of stock, and now they're going to float another 10%. So I think people are working off the premise that you get this flood of uranium coming into the market. Like I said, I don't think the Kazakhs produce nearly as much as people anticipate. I don't think Cameco brings it back anywhere near the $40 range. I think you're well into the 50s, and the new projects aren't coming online. So no, I don't think there's this mental guidepost that people have in their mind, and I think it's just because that's where people look at where they started talking about where's their contract book. These companies have been decimated. Cameco's been crushed. Kazatomprom, if it weren't for the tenge devaluation, where the tenge went from the high 100s to 370, where they cost in tenge and sell in dollars, their margins would have gotten pounded. And now when you look at their future plans, it's based on 340 tenge. We're at 360 today, I think it is. Really? Like, get an oil rally. It moves with the ruble. Get the ruble rallying. All of a sudden, their entire cost structure changes. Look at how much capex they've delayed over the last several years that they got to go spend because ISR mining has big depletion curves and they've not been spending there. There's this view at their costs are going to come back online at 40. Okay, well that's great. Have another beer, sit down, and assume you know the uranium world because that's kind of where you think it's going to come back on.
So what indicators do you look for when it's time to close uranium investments?
That's the hardest part. The hardest question I get asked is if my thesis is right. Again, I could be wrong. If my thesis is right, the hardest part is when do you sell? And that is where, if the thesis is right, you obviously as an analyst, I'm looking at valuation. But I've often seen things go way to extremes. People get way too excited on the upside and way too pessimistic on the downside. So I think you have to step back and say, okay, what do I own? What's this thing worth? What would a reasonable buyer pay for these assets? What's the reasonable multiple an investor would pay based on the cash flow? What's a reasonable multiple an investor would pay for an acquisition if that's how you're thinking about it? And then when the animal spirits are out, step aside and let the market take it over. And just when you feel like it's starting to get a little goofy because it hasn't traded there before, and if you're looking at the supply-demand dynamics and it's originally what you thought it would be, and you're kind of there, you just kind of, that's where the art comes in. Nobody ever went broke taking profits. Bulls and bears make money, pigs get slaughtered, right? So, I just kind of think you just got to it's your own personal feel. Yeah.
Right. Okay. And so moving on, and then of course, when this happens, it's time to look for some other contrarian plays. And of course, we have no idea what those are going to be because we don't know what the future holds. So
exactly.
So one other point. So some folks were interested in knowing if it was possible that when you're doing certain interviews and stuff at conferences and talking to kind of the industry key people, would you be willing to offer up some of these kind of raw discussion audios, or is that something that's kind of not really possible at this point?
It's something I have no interest in doing. I'm not selling uranium research. I'm not selling. I'm not looking to monetize it in certain terms. Again, that's my proprietary stuff. Like that's, I have the fund and I have, the vehicle, and that's for my own consumption. I'm happy to share my insights from it, but like a seat at the table, leave that to some newsletter writer who's going to say that here's the seat at the. I want no part of it.
Well said. So how can potential investors reach out to you in Sachem Cove?
Well, first they have to be accredited, and we have a website. My partner in the business handles any inbound inquiries. I think you could reach. I don't even know actually. You could probably just reach out to him on the website, and he'll if there's a contact us tab, and then he could get back to you.
Okay, very well. And of course, we know that Sachem Cove has a Twitter account, so there's some easy ways. Google search, you can find Sachem Cove quite easily, or just check out Mike's account. Mike, well, we appreciate it. Good times, and good luck as we get underway.
Andrew, I enjoyed it. Thank you very much. It was great chatting.